want to get our next guest in here. Eddie Ghabour is here, owner of Key Advisors Wealth Management. Thank you for being here. We got our CPI print today. We get PPI tomorrow, and we have had some serious back and forth over the unchanged line activity of late, but the trend has been lower. How are you feeling about the market these days?
We're very concerned about the market. You know, we've always been a data-driven firm, and we came into the year extremely bullish for the short term. We were buying dips, and then look, the data changed, and when the data changed, we changed with it. And now we're doing the opposite. We are taking big rally days to take down some risk, because I think we have some major headwinds ahead of us. Mainly when you take a look at some of the things that DC is doing a good job of telling us what they're going to do. They're trying to get interest rates down because we have a massive amount of debt that's coming due this year. We have nearly $8 trillion of debt coming due in the next 9 months approximately, with a big tranche of it coming in the next few months. And when you look at our interest on our deficit, the numbers just came out. They're up 17% year over year. That is an unsustainable path. And so we have to make some tough decisions. And that means if we're going to take $1 trillion out of the budget, which is what they're trying to do with Doge, and they're going to cool inflation by getting interest rates down, growth is going to come down. And so I think the trend over the next few months, unfortunately, is going to be bearish. And I want to have a lot of dry powder because I think there'll be some generational buying opportunities on the back end of this. I don't think there's a Fed put or a Trump put anywhere near the levels we're at right now.
What's interesting is when you talk about U.S. debt and our deficit, it's a big deal. It's something that people were very conscious of when they were voting. I mean, they really felt it was imperative to sort of attack that, and that is what they're trying to do. Whether you like how they're doing it or not, I don't know. But the big point is that, as you say, some of these, are calling. They have to pay up now, and they got to get this in order. What's interesting is how you're selling into strength right now, taking some profits, and you think that there's going to be this generational opportunity. When does that come? When are you going to buy a dip and say, oh, this is it. This is the bottom. This is my opportunity?
Obviously, it's impossible to pick the exact time. Right now, based on how we're looking at things, I think we're going to probably be in the third quarter when that happens. I think there's too many people right now that are still complacent and don't think they're actually going to follow through with the policies that they're telling us about. And when you look right now, the S&P coming in the day was really only down 5%. Yet you've got some tech companies that are down 30%, 50% from their highs. So think about if the S&P just has another 10% correction to the downside, which I think is probably a best case scenario, what will some of those names do in that environment? So I hope I'm wrong this time, but right now the data and the information that we are getting directly from DC is telling us, they said be ready for a detox period. And that means the tough decisions that people voted for, which is getting debt down and taking government money out of the system, has the opposite effect of when you inject a lot of unnecessary capital. So we enjoyed it as it blown markets up and asset prices up. So we have to realize if you do the opposite's going to happen to asset prices, and that's why they're going to come down.
Right. So you think that the S&P will head into bear market territory? I mean, for example, 1 month we're down, let's say 3 months we're down 8%. You see another 10% to the downside, right? For the S&P.
I do.
And that would be in the second quarter, because you said April, May, June, and then it's not to the third quarter that you see some relief.
That's correct. And the only thing that would change that is if the Fed makes a massive change in regards to trying to get inflation to 2%, and they start doing some type of quantitative easing, which I don't think they're going to do, or if the Trump administration changes their stance on Doge and goes less aggressive. Right now, Doge is targeting $500 billion to $1 trillion of cuts. And to me, it doesn't look like either one of those are going to stop. And look, this is probably one of the best things that could happen for us long term. But in this little air pocket here, investors should protect themselves. They've had a great run. It's okay to have a bear market for a few months, just as long as you're not in the way of it.
Understood. So how do you position a portfolio? Are there opportunities? Are you shorting anything? How does somebody make money? Is there any stocks you're recommending right now?
Right now, we're actually, the only area that we would be adding to would be our gold position and some fixed income positions. We have increased our money market holdings quite a bit. Sometimes it's okay to just do nothing. And I think right now, depending upon how you're positioned, it's okay. So we do not short the market. That's something we do not do for our clients, because that's something where you could actually be right and still lose money. So that's a game that we don't play with our client assets. So right now we're just in protection mode. We have about 30 to 60% on defensive side for our clients based on their risk tolerance. And we're going to be patient and wait for opportunities.
I want to hear about some of the fixed income that you find interesting, because I do want to talk about GLD more in a second. But when you talk about fixed income, obviously short-term treasuries or notes were doing very well. As yields come down, maybe those will be less attractive. What do you think will work in fixed income?
So fixed income right now, if you think growth is going to continue to slow, you can own some government ETFs that are going to pay you a yield. And if the interest rates go down, the asset price will actually go up on that underlying asset. So that's a way to buffer. We've got some high yield debt that has actually done pretty well from a dividend perspective. But frankly, the spreads are starting to widen. And we're probably going to cut bait on those as well, too. When you go into a growth scare like we're going into right now, the fixed income markets on the high yield side can have a lot of volatility as well, too. And that is something that I think some investors don't realize, is that you can lose money on fixed income also. So you want to be a little bit safer, more on the shorter end on the government side, in my opinion, right now. And that's going to be the safest way to play it. And you can probably get some appreciation on that underlying asset. And then use that as ammunition to buy some wonderful names after they've had a big drop.
Yeah, I'm curious to know what those are. But I do want to get to GLD for our viewers. They always like some actionable advice. Would you step in and buy some even today on GLD? I mean, we know gold has run up in the first place.
Gold has been one of the best places to be this year. And if the growth scare gets worse over the coming months, I think you're going to see gold continue to do well. So if you already have a position in gold, maybe wait on dips. If you don't have a position in gold and you want some defense, you can dip your toes in the water now and dollar cost average on down days, because that, in my opinion, is one of the ultimate safety plays. So if things get worse, I think you're going to see a bid for gold. And look, we don't like playing defense. It's boring, but sometimes boring is good when you're in a down market.
Yeah, understood. And when it is time, you said it's maybe the third quarter, that you'll start buying a lot, and you said it could be a generational opportunity. What do you think is going up first? What are you going to be buying?
So what'll go up first are the areas that are going to get hit the hardest. And right now, it's no doubt the semiconductors have been hit really hard. And some of our favorite names, like we'll use NVIDIA, for example. I love that company. I think they have a great fundamental story. But that just goes to show you, it doesn't matter how good your company is. When you have a down market or a bear market, it's going to take the good companies with it. I think they were coming in today down 30% off of their highs. We did reduce our exposure there. We'll be looking to add that back in. You look at names like Palantir, we'll be looking to add names there. And then, on the other side of the spectrum as well, too, is financials have really struggled. We have cut bait on financials as well. We cut the rest of our financial exposure today. And we'll look to be buying those. I think it's going to be an area where it's going to be a broad-based sell-off, because everyone's going to be so worried that we're going to have a recession. And I don't think we're going into a recession. I think it's going to be a big drop in the market in a non-recessionary environment, which is the best case scenario in that type of situation.
Okay, that's worth noting, because I was going to ask you that. So a big drop in the market in a non-recessionary scenario. Thank you so much, Eddie Ghabour, owner of Key Advisors Wealth Management. Thanks, Eddie. Good to see you always. Thanks.